thank you very much for joining us from your home offices and living room sofas this afternoon for what I'm sure is going to be a very interesting, thoughtful, and educational session, appropriately titled Demystifying Quant. Looking forward to a little bit of nerd out on all things ETF and quant this afternoon. I'm certainly not the one that will be doing all the talking today. I'd like to introduce one of our partners here at NEO, the founder and CEO of SmartBe Wealth, Rod Hurd. Rod, welcome, and thank you very much for joining us this afternoon.
Oh, it's great to be here, Eric. I always enjoy our conversations, and hopefully the people that have tuned in will have a good time with us.
Oh, I'm sure they will, knowing how our chats tend to go. For the crowd with us today, just two small housekeeping matters before we get started. We're going to try and stick to our 30-minute window. If we bleed a minute or two, we'll let you know. We'll get you right back out to your regularly scheduled afternoons. And very happy to take questions through the chat box on your screen. We'll work them into the discussion if we can. And if not, we'll come back for them at the end of the presentation today. So Rod, with that, let's get straight into it. Maybe one or two quick things right off the gate to get us started. You and the team at SmartBe, you're certainly a newer name on the block. You've got a suite of ETFs you recently listed with NEO last month. Can you give us a quick primer on and an intro to SmartBe Wealth, who you are, and why you decided to get into the ring and build up an ETF business from Calgary?
This all sort of started back in and around 2017. My partner, Art Johnson, co-founder of SmartBe with me, gave me a call, and he was doing some interesting work with some executives that in the Calgary sphere that were dumbfounded why they had just closed a transaction and their stock price went south. The executive team thought the transaction was accretive, thought it was very strategic, that thought that the market would act favorably associated with what was going on. And so they called Art because they knew he was a sort of one of the pioneers in quantitative investing, and they'd reached out to the Peters and Co's and the traditional brokerage channel, and who had phoned down to Toronto, Bay Street and Wall Street, and everybody was saying it's the machines that are doing this. And so it's really this concept around quantitative investing, and we had a clear indication that the Canadian executives, the Canadian public, the Canadian market in general was quite a bit further behind than most other capital markets when it related to this concept of scientific investing or quant or algorithm-based investing. And so we did a bunch of homework, and we identified in our own minds that most major markets have adopted quant strategies for a significant portion of their wealth and their wealth management, whereas the Canadian adoption rate was terribly laggard. And so we actually saw this as an opportunity to come into the market with some new and innovative products to hopefully catch the wave when the tide started turning and the Canadian marketplace sort of woke up to the benefits of including scientific method-driven portfolios and statistical analysis into their portfolios. And that's sort of what we're here to try and do. We're trying to mark our position as the preeminent quantitative finance firm in the country.
I love it. And certainly the first from Calgary as well, which is something else new and different. I think it gives you guys a nice pivot point to go both directions in our wide and diverse country. So kudos to you for kicking that off.
I know we were the first with NEO, but I think our friend Tim Pickering over at Auspice Capital actually had the first ETF that launched a few years prior to us, but we're certainly the second that we're out in the space. And we kind of chose the ETF wrapper because we're looking around the world and the transparency associated with the ETF disclosures and the cost reduction and the ability for people to, I'm not sure everybody fully understands ETFs in our space yet, but this whole creation and redemption of, quote unquote, infinite liquidity in the vehicle and low cost all kind of made sense for us as a forward-looking firm trying to capture this innovation space.
I love it. You're spot on the first reference. Good shout out there. Give us a bit of a clue. You stepped in on quant, and that has been, I think, a hallmark of your business. And I remember some of our first meetings as well, being different, being focused on education, sharing that information out to the street. But let's talk about quant specifically to start. Can you walk us through the vision, mission, how you landed on that. You mentioned Art's history in this space, and kind of give us a bit of a primer on quant investing as a whole.
For sure. So quant's a funny word. It's one of these collective nouns that can mean almost anything. In fact, if you think about it, it just means numerical analysis. And everybody in the world, when we're looking at evaluating returns or picking a stock or looking at companies, uses often some sort of quantitative analysis. I'm not going to go down the technical lane because there's a whole bunch of nuance in quant, in high frequency trading and algorithmic. And again, all these words are kind of scary, but I'm going to try and simplify it as I talk to my niece or nephew who's in grade 6 or 7. We kind of think of quant in three major buckets. The first bucket that I think is the most prevalent in people's minds is creating ETFs or mutual funds that mimic a market index, whether it's the TSX 60, the S&P 500, the Russell's 1000, the EFI market in the international space. Basically, all of these market indices have been created to track a market over time, and they're market cap weighted. So the biggest companies get the biggest proportional sharing of these indices. So you're really getting a glimpse into the top 20% of the companies in a market and how they're performing. And so very easily, if you ask almost any investor over the long haul, what's going to do better for your portfolio, stocks or bonds? Well, people will tend to choose stocks because that's been what's been happening in history. And so these market cap indices are a very inexpensive and efficient way to get investment exposure into what the academic community calls the equity factor. Just equities versus bonds is kind of the first basket of things. And the phenomenon lately is that the prices of these ETFs that are market cap indices are trending to zero. And that is a really, really great thing for all Canadians because just having exposure to equities over the long term with your patient money, and again, long-term horizon is integral to our thinking. So, some may think 3 to 5 years is long-term. We think 15 to 20 years is long-term. In particular, for those that are millennials or younger, the most important thing to be doing is to getting your money into the market and to keep investing. Savings is absolutely integral to the long-term success. So there's just one bucket of quant that's market cap index related, that's very easy to replicate, that's very cost effective and inefficient. It's one big can. The second bucket we think about would fall into something that people call fundamental analysis. And most of us who've had experience with the big banks, they think about the research team. And, you always get a buy, a hold, a sell, a rating on various companies. And what these research analysts do is they dive deep into the financial statements of the companies. They dive deep into the industry trends and the market nuance. And, if we're to pick something like oil and gas, which we're familiar with here in Calgary, they'd look at the number of drill rigs that are out there. They'd look at the future contracts on oil and gas and the West Texas Intermediate. They'd look at currency exchange risk, and they'd build a model based on the fundamentals of the company. And based on today and what their model says, they'll come up with a hypothesis. They'll quantitatively say, you know what? I think this stock is undervalued in the market. And therefore, if we buy it today, based on if all these drilling happen, if all this BOE comes online and the price of oil goes from 40 to 50 bucks, wow, this company's really undervalued right now. And so it's a fundamental analysis on a company by company basis that's trying to predict the future. That is a vast amount of quantitative investing today, and it's highly quantitative. It's sophisticated. It has very bright minds trying to look at these nuances. The reality of it is, when you study people trying to predict the future, when the academic world goes and looks at picking stocks in the fundamental analysis world, 95% of the time, it doesn't even beat the market. So you got to scratch your head and go, should I be paying for that 5% that's going to beat my passive market index? Or should I just be investing in a zero cost or next to a very low cost way to get my equity exposure? And so I would suggest that much of Canada, in particular in the retail space and in the advisory space, is firmly entrenched in this fundamental analysis world and thinking about the future. Like, you think about what's hot right now, it's AI, it's batteries, It's biotech, all the revolution, these platform companies that are revolutionizing. COVID. The world has changed and markets have changed. So there's many smart people out there that are trying to uh, align with their personal philosophy of how the future is going to unfold and make a bet based on that. So that's quantitative analysis based on the fundamental space. And again, that's not what we do at SmartBe. The third camp is what's called scientific investing, what we call scientific investing, and is based on scientific method. And keeping that simple, we all understand scientific method because we learned it in elementary school. You make an experiment, look at some variables, understand what those variables did in the experiment, and have a result of the experiment. And this is basically what all of the universities around the world have their PhD students and grad students doing in something called quantitative finance. It's a discipline of business and economics. And basically, what happened was in the 1960s, a guy named Eugene Fama in the University of Chicago did something innovative. They digitized the New York Stock Exchange, and then they hired an army of grad students to digitize all the financial statements associated with the companies. So now you've got a data set that you can look back to the 1920s and determine, okay, are there anything in these financial statements of the companies that actually relate to stock price increase, and not even just relate to that there's a causal effect. Correlation is one thing, like the moon rises and you can correlate lots of things to the moon rises, but what causes the moon rise? Well, it's gravitational pull, and it's trying to find that cause that the scientific community, the academic community is looking at. And so there's a whole body of investment that investment professionals and academics that have identified that there are 5 or 6 fundamental attributes of a company that over the long period, and again, we're talking 15 to 20 years in our brains, the longer you're with the strategy, the higher the probability is that the outcomes are going to be there. But that these what are called factors or characteristics or attributes of companies actually increase long-term performance. Some of them are pretty easy, like size is one. Over the long haul, small companies tend to do bigger than big companies. Quality is another one. Over the long haul, companies that have financial statements that indicate that they are high quality, that they have strong earnings, no debt, that they're not going to go bankrupt, that they're not being aggressive with their accounting policies and trying to hide things. High quality companies tend to do better than low quality companies. Another one is value. Cheap companies tend to do better than expensive companies. At certain points in certain cycles, some industries, some companies go out of favor. Oil and gas has been out of favor for quite some period of time. It's now coming back in favor, but and from earnings and the fundamentals of the company, you can determine by their price in the market whether they're cheap or expensive to their peers, and you basically buy the cheap ones, and over time they outperform the expensive ones, the Googles, the Facebooks, the Teslas, the Shopifys of the world. And the other major factor that's kind of been mutually agreed by most of the scientific community is momentum. And this is a bit of an odd one because it's a new one. Momentum, the first 3 factors that I mentioned were really associated with traditional economic theory about equilibrium and the fact that markets are efficient and that there is a body of academic evidence and science that says traders in a market have perfect information and they're always paying the exact perfect price for a share at any given time. And that theory was, lock solid for years and years. And it's only, and again, University of Chicago, leading edge guys, they started to develop a second hypothesis, which basically says that humans are a bit crazy. We're full of all of these emotional behavioral biases. We fear loss twice as much as we like gain. We have recency bias, so things that are near in our brains and affect our decision making. There's just a whole bunch of these things that computers are way better at than humans at making financial investment decisions that are level set on reality versus biased based on something that we're trying to deal with in our reptilian brains. So this new science of behavioral finance came out that basically says humans are crazy, but we're systematically crazy. We make the same mistakes over and over and over again. And can we actually take advantage of systematic mistakes in the marketplace and earn superior returns? And hence the momentum factor was born. And momentum is really easy. You just look back a year and you determine in that marketplace which stock prices have increased the most over the past 12 months. You do a bunch of fancy other things because that's what the academic guys get you to do, but it's a really simple complex concept. It's just what price momentum in stocks has done well, because they tend to continue to do well. And it's actually taking advantage of the fact that humans tend not to recognize that the price is going up slowly and steadily early enough, so they get into the stories too late. And then they tend to hold on to the stock a little bit too long at the end when the shine is off and it doesn't any longer exhibit price momentum. They sell too late. Well, you can build an algorithm that takes advantage of that and consistently, and again, over the long term, helps you underperform. So helps you outperform. So this is the flavor of quantitative investment that SmartBe is sort of hooking our horse, our cart to that horse. And we've been very fortunate.
You've got an incredible group of partners around you too. I mean, I know you mentioned, at the end of it, it takes a lot of brain power, a lot of thought, a lot of foresight to kind of run these models and stitch them all together. Do you have that brain trust running in Calgary with you? Or have you found a partner to deliver on that?
Well, we do have that brain trust here in Calgary, but the brain trust in Calgary is really associated with Art, our founder, who is one of the earliest adopters of quantitative scientific investing in the Canadian marketplace. And we're just delighted to have attracted a talent like Priti Sarao, who has a CFA and has spent time in world leading quantitative investing shops. So we have a lot of horsepower at the portfolio management level where we're interfacing with clients and helping build strategies. But you're absolutely right. We were very fortunate, and we got hooked up with a group called Alpha Architect out of Philadelphia in the States. The two founders there, Wes Gray and Jack Vogel, are both PhDs. Wes actually went to the University of Chicago, so the apple doesn't fall too far from the tree. And his thesis advisor was Eugene Fama, the Nobel Prize winner in 2013 for his efficient market hypothesis, this hypothesis that has a mathematical theorem that says people are paying the right price. And interestingly enough, the other part of the University of Chicago is on this behavioral finance. And so Wes kind of in his maturation, and he's got a fascinating story about how he came to be an asset manager in his entity. But he's adopted both of these hypotheses that efficient markets work and behavioral finance works. To explain the most in excessive returns, you need to adopt both of these strategies. And so Wes and Jack and Alpha Architect run our indices. So our funds all track an index, and our job in Canada is to do the trading and build the portfolios to be very consistent with the indices. But Wes and Jack are the two PhDs that run the algorithms, and they're very sophisticated. And their sort of ethos is empower through education, keep transaction costs low, and only adopt strategies and methodologies that have been publicly debated in the academic journals and published, so they've been beaten up by their peers sufficiently.
I love it. And you hit on a few key things there for me. And you talked about the ETF structure and the vehicle. You're transparent in your approach to market, educational, trying to bring the world into a similar thesis or ethos way of thinking about their investment portfolio. Education, obviously a really key and core component, especially with ETFs. They're getting more wider spread now, but there's certainly a layer of education to do at how you bring that transparent quant methodology into the ETF and make it really a portfolio solution for the advisor and do-it-yourself investor crowd. Now, you mentioned a few other interesting words, and my favorite, starting off with the F word in there. Factors, and talking about which ones you picked. Your business today in Canada is focused on momentum and value as the two factors that come together.
Correct. So we have 4 funds. 2 of them are value based, so we're picking cheap stocks. 2 of them are momentum based. We're picking stocks with strong price momentum. 2 of our funds are Canadian focused, so they're focused on the TSX market, and 2 of our funds are focused on the US market, so the S&P 500 is the market that we've benchmarked against.
I love it. It gives investors broad-based exposure, and ultimately the strategy that I think you're working towards as a manager in Canada makes a ton of sense. I want to switch gears to something else. You highlighted over the course of your discussion, especially in light of the market conditions we've been seeing in front of us, and that's really the behavioral economics piece. The rational investor, we hope, is a rational investor when it comes to stock picking and investing in companies these days. And I think we've kind of gotten a bit of a clinic and a deep dive looking at some of our friends in the US and what those stocks have been on over the last even 2 to 4 weeks. You also spend a lot of time talking with advisors about behavioral economics and that part of behavioral investing patterns, when to invest, what to do with it, when to hold. Can you talk to us a little bit about how you and the team at SmartBe are really bringing that lens of thinking about investing into the whole investment picture with the advisor community? Can you give us a bit of a primer there on what you're really looking at?
Yeah, absolutely. I think if you ask anybody, what's your best investment? What's your best investment, Eric? Right now, what's your best investment?
Ironically, it's a handful of very well performing ETFs over the last 12 months, but they're all focused on small and mid cap, high growth stocks.
But you said the key word. Your favorite stocks are the ones that are performing the best.
Mm-hmm.
We are programmed for performance.
Yep.
And it clouds our rational thinking, because all academic evidence points to the fact that past performance has very, very little to do with future performance in a stock. And so, really the foundational belief system that we're asking the people that want to work with us to buy into is that let's draw a line in the sand at the present day. And if ever our thinking is about the future, it's mistaken thinking, where we're trying to read into the 8 ball or trying to predict the future. We think is a mug's game. Let's let the past inform our investment decisions and build a process that's repeatable, that's codified, it's in the algorithms, that's transparent, that lets you know exactly how the stocks are being picked, and share that with the rest of the world. We share our stock pickings every day on our website, and every quarter when they rebalance, we pick out the new ones, and we even sort of get at a very high level as to how we deal with our screens. Obviously, at the coal face, there's a lot of nuance where Jack and Wes are working, but we've decided to tell the world that we're not the best stock pickers in the world. We actually believe in scientific method, and we believe in the rigor that these academics, in battling for which investment strategies show causation and correlation in the history, we're just going to build our strategies based on those factors. And we're not going to question it. We're not going to try and worry about performance. But what we do know, which is awful, it's awful for all of us, is that these factors can go through long periods of significant underperformance. Value is a great example. Value has been suffering as a factor in both Canada and the US for a number of, in Canada less so, but for a number of years. And so really what our job now becomes is in coaching the community that we outreach to. Now, we, at the broadest sense, we reach anybody who's managing a portfolio, whether that portfolio manager is mom and dad at home doing it self-directed, whether it's an advisor, whether it's a small institution, a family office. If you've got a portfolio of investments, that's the audience that we're speaking to. And our belief system says that every portfolio manager should have a significant depending on their own philosophy, portion of their portfolio into scientific investing. And we're kind of saying, don't come to us for the investment advice. The algorithms are doing that for us, but what you need to come to us for is validation that the process is sound, the logic around why that process is continuing to pick the stocks, and why we are why the algos are doing the exact right thing, but they may be underperforming some other benchmark that's doing something crazy at a point in time. Continue to reinforce all of the and keep abreast of all of the latest academic information that's being debated to determine, has something foundationally changed, or can we still rely on these factors to give us long-term results? And really be the behavioral coach. Let's not do something stupid like sell when it's low. Let's not do something stupid like buy when it's high. Let's understand your financial objectives. And if you have shorter term financial objectives that you need cash, this is not the right strategy. If you need cash in 2 years, probably don't want to go into these types of solutions. But if this is long term money that you want to have a high probability, stack the odds in your favor of beating the markets, because they have in the past, this is the type of money that we're looking for. Long term partnerships. And the education component is integral, in particular as it relates to these long periods of underperformance.
I was going to say that that's a bit maybe the recurring theme these days as well. Now more than ever, perhaps, time in the market, especially in a strategy like yours, is going to be more important than timing the market per se. So that's something that both encouraging to hear from you and the team. Obviously, hands wrapped a number of very integral partners in doing your homework, your research, your analysis, the trends in the market, and obviously your front lines working with advisors and folks that are managing money for the rest of Canadians as well, to their benefit with these strategies. So it's something that certainly important to bring and highlight over the course of these discussions for everybody to see and understand and get a chance to really wrap their heads around.
And we want to engage with people. We want to share our knowledge. We're not hoarders. We have some great resources. Probably the most incredible resource that we've found out there is the Alpha Architect website. Wes and Jack, they are voracious in their attention to any and all new information, and they share that. So if people really want to do a deep dive, we're trying to take a more simplistic approach. We think that that academic lens is for a few. We've got great resources on our website. We're doing we've launched a podcast where we're trying to demystify a bunch of things. In fact, we had Maddie Quinlan on one that's just about to come up, and we're to your point earlier about length in the market. Like, there's some fascinating study about Fidelity that their best investments are from those people that have died and not touched their accounts or have forgotten them for 20 or 30 years, and that we make a mistake as humans. We have a bias to trade too much, and that less trading is kind of a better thing, which I thought was quite humorous. We launched a webinar series. We've done 2 of the series. We started with investigating momentum, then we are investigating value. And coming up on April 21st, Jay Barrett, who runs our national sales organization, and Wes will be talking about value and momentum together and how to build portfolios and those sorts of things. So there's a lot of great resources out there. It's hard to cut through the noise. There's just so much noise out there, and the word like quant is a busy collective noun. So if you want some help demystifying things, give us a shout and we'll be glad to engage.
Well, it's great to hear, obviously, and both education on the ETF itself, the wealth management practice as a whole, the portfolio of strategies that you and the SmartBe team are delivering out to investors. I'm sure all are open season for you guys. Happy to chat anything and everything anytime. We'll make sure, Rod, we circulate that event. It definitely going to be something interesting. I'm always keen to see Wes hop back on stage. I had the distinct pleasure of meeting him alongside you and a few others at a couple of market opens along the way. So I'm keen to get that out. We'll make sure we circulate that amongst our partners. To our advisors and investors in the crowd, you've heard a lot from Rod today, their philosophy, their origins, how they're working to deliver education, value, information out to the street, ultimately to help with the whole investment life cycle and process. You heard a bit about their tickers on NEO, the two strategies they're running in Canada, Value and Momentum, and the same two in the US, supported by Alpha Architect in the US. Rod, parting words, if you could give us a pearl of wisdom to our audience, especially in this day and age, what would it be?
In Canada, we don't have access to the best strategies. And not all the ETFs and mutual funds that are pretending to be, from a marketing perspective, what they say they are, would pass the scrutiny of an academic review. Many of them are closet indexing. They're basically trying to look like the index and have a little bit of exposure to some of the factors. And so we see a great opportunity for portfolio managers to optimize their portfolios and buy cheap beta and look at concentrated factors as an alternative. So that's really what we're focused on right now.
I love it. Look under the hood, do your homework, and open for questions everywhere and anywhere, I assume. And as you already covered, you guys are fully transparent in your approach, so I'm sure they're going to find exactly the root of everything they're looking for. To our audience today, thank you very much for joining us. You heard a lot from Rod, as he mentioned, open to connect. He's got both him and the team around him to tackle any questions, show you a bit more about what they're up to at SmartBe. But Rod, I certainly appreciate you taking time out of what I know is a busy Tuesday to meet with us and some of our partners here at NEO. Good luck with the event, of course. I know this is the beginning of the year. We got a ton of fun in front of us, but really appreciate you joining us for another NEO Spotlight and look forward to welcoming you back to the exchange again soon.
Thanks so much, Eric. And it's a real delight to work with you guys. I think, we chose NEO on purpose because of your value system, because of what you're trying to accomplish from the transparency and data management and the natural trade. So thank you very much for hosting us, and we'll look forward to chatting again soon.
Rod, my pleasure. You're always welcome. Can't wait till we get to do this again in person.
Yeah, that'll be fun.
Definitely. And I got a poster ready for you and Art, so get ready. This is NEO and SmartBe signing off for today. Thank you very much, everybody, for joining us. Happy Tuesday.